Good morning, everybody. Welcome to the webinar that's put on by Rensco in Pursuit, everything you need to know about small business loans. My name is Keri Pratico. I'm a Senior Business Development Officer at Pursuit. And I just want to take care of a few housekeeping items this morning before we get started. Everybody is on mute. We just ask that you stay on mute. If you have any questions, there will be time at the end. But during the whole presentation, there's actually a questions tab in your webinar that you can ask questions in at any time. I likely pause a few times throughout to see if there's any questions that we can answer before we get to the end of the broadcast. I just wanted to thank the staff at Rensco for collaborating with us and letting us put on this webinar. And I want to thank my coworker and good friend Theo, who's in the background, that's going to be monitoring the chat tab. So we are going to get started with everything you need to know about small business loans. I do like to let you know a little bit about me. My name is Keri, as I said. I am a Senior Business Development Officer at Pursuit. I have worked upward of 2 decades in small business or economic development. I actually ran my own business, worked in conventional lending, and also worked for CDFIs, and that's something that will actually define today for you if you're not sure what that is. So I work for an amazing company, Pursuit, and so a little bit about Pursuit. We're a community-focused lender. We're 100% invested in our borrowers' success. We have a history of 65 plus years offering innovative lending solutions to help businesses and owners achieve their dreams. We offer loans from $10,000 to $5.5 million in all phases of business, from startups to multi-million-dollar established stable companies. We also offer 15 plus loan programs through Pursuit, and we'll actually go a little bit into detail about that today. So that's a little bit about me and Pursuit. And then today, what we're going to cover is, oh, I'm sorry, my next slide isn't. So what we'll cover today is the different type of lenders that are available to you. I just introduced you to Pursuit. We're actually one of them. We're going to go over determining the right loan for your needs, what questions you should be asking lenders, what lenders look for in a strong applicant, and what information you'll need to apply. So to jump right in, this is our capital continuum slide. It is a great slide to show all different phases of business, from new to stable businesses. If you see on the left side is the sources of capital. It goes you and your partners, friends and family, alternative institutional lenders, alternative community lenders, and conventional banks. In the middle is the different stages of business: new business, growing business, and a stable business. And on the right are characteristics of the lenders, both pros and cons. So this is basically what we're going to be covering today. What this slide is actually showing is a newer business. It's a little bit harder for newer businesses to get capital through conventional banks. So newer businesses generally go from their own capital or partners or owners that comes from personal savings, credit cards, home equity line of credit, bootstrapping, angel investing. Now with that, it's essentially risk-free because of your flexible repayment schedule, but it also is could be a little bit risky. If you're borrowing money, you know, it can be a little risky to the relationships that you have. The next step up generally for newer businesses is friends and family. A lot of friends and families will give gifts or loans, possibly some crowdfunding. Also has the same characteristics as borrowing from, as your own sweat equity or your partner's sweat equity. Now, the next stage is a growing business. For the sources of capital for that, it's alternative institutional lenders and alternative community lenders. So those are loans from micro lenders, SBA lenders, CDFIs, credit unions, and other community banks. We'll actually be going over that today. For institutional lenders, it could be online peer-to-peer lenders, factoring companies, merchant cash advance lenders, etc. With the institutional lenders, you'll find that there's higher interest rates and shorter repayment terms, but they can be a little bit flexible, which is a positive, and they can have a faster turnaround time for approval. They tend to be a little bit more costly in the fees. Generally, you have to offer your personal guarantee, and they're not as heavy on paperwork as maybe an alternative lender or a conventional bank. So for alternative community lenders, the benefits there is they have a low to average interest rate and longer repayment terms, and they're generally cash flow based. If you're not sure about cash flow, we are going to go over that in a little bit later, and we can talk that into a little bit more detail. These tend to be a little bit heavier on the paperwork and slower in the process, and also you need to offer your personal guarantee. And then at the top of the ladder is the stable, more established businesses. They're going to go to conventional banks. Now, with conventional banking, you're looking at lines of credit, term loans, asset-based loans, or construction loans. You're going to be getting your prime, your market interest rates here, and most likely your most favorable interest rate. They have varying repayment terms, and that would be based on the type of loan that you're applying for. Any questions on that, you can actually ask me after this webinar. You'll have my contact information, and we can talk a little bit more in depth there. These are also based on cash flow or collateral. These tend to have a slower turnaround time. Most likely what happens is when you apply at a conventional bank, they gather all the paperwork, which we'll discuss later in this webinar, and then it will go back to an underwriting team who are professionals in analyzing your request. So, and with a conventional bank, you'll find that a higher personal credit score is required as well as a personal guarantee. So we'll refer to this a lot in this webinar, but it's a great slide, and you'll also get a copy of this at the end, so you can refer back to this. Now, predatory lending, which I'm sure you've heard of, it can be called predatory lending or payday loans. These are actually very common, and we have seen an uptick in people applying for and receiving predatory loans. So we wanted to give you just a little overview of what this would kind of look like and how you can kind of recognize a predatory lender. Not only did we offered you that website, Know Your Rights, right up on the right-hand corner, we wanted to let you know that how you can kind of recognize them is you receive unsolicited loan offers. I'm sure you've seen stuff come across your email where $50,000, quick, easy, you've received a check in the mail. Those generally indicate some form of predatory lenders. You're pressured into quick decisions with predatory lending, and they also, a lot of them don't provide the APR, so you cannot see what the APR is. And if you don't know the exact definition of APR, we'll be going over that as well. The repayment terms are aggressive. Sometimes I've seen them have payments come out weekly or even daily, and there are obstacles to paying off the loan, and it's almost as if you're trapped in a debt cycle. So this is actually something that we want you to be aware of, because this is much different than alternative lending. So the third step on the ladder is you, your partners, then friends and family, then alternative lending. But a lot of people can sometimes misconstrue predatory lending for alternative lending. So what I would like to show you next is, why are we looking at alternative lending? So banks, which is conventional lending, are a great source of funding for businesses with a proven track record of profitability and collateral. So those are great for established business, as you saw on the Capital Continuum slide. So for new and growing businesses, they're unable to qualify for conventional lending and small business funding. Alternative forms of funding are available through an SBA loan, a community development financial institution, also known as a CDFI, and fintech are online lenders. Some of those, like Sophie and Ernest. To go into a little bit about SBA lenders. So the SBA, Small Business Administration, they actually don't provide loans directly. So the SBA partners with banks and other lenders to offer guaranteed business loans to those who aren't able to qualify for traditional funding. Pursuit just happens to be an SBA lender. So we also offer SBA guaranteed loans. So there are SBA loan programs for every phase of small business, like I said in the beginning, from startup to established businesses. The application process for the SBA loan is a little bit more detailed. and it can be a little bit more time consuming. So it can take a minimum of 4 to 6 weeks, sometimes even a little bit longer, depending on paperwork that is needed, which is something we'll also go over. Pursuit is not only just an SBA lender, but they're also a CDFI. So I would like to tell you a little bit more about CDFIs. So CDFIs are private financial institutions that operate with a primary mission of serving low-income communities. So they're certified by the U.S. Department of Treasury CDFI Fund, and there are more than 1,200 CDFIs at work in all 50 states. CDFIs, including Pursuit, we tend to have less strict eligibility criteria than traditional lenders. Traditional lenders, conventional lenders, banks, basically all the same thing. They tend to have these harder lines. They have, a minimum credit score, and I'm not saying that CDFIs don't, but the conventional lenders tend to have a higher one. I don't see much below 700 offered in banking, but it is possible. CDFIs, Pursuit included, can go much lower than that. So while banks have these rigid lines, the CDFIs tend to have a little bit less strict. What's awesome about Pursuit, and I'm not sure if this pertains to anybody in the webinar today or listening in, is we actually serve New York, New Jersey, Pennsylvania, and Connecticut. So that has a great chance of touching you and your business and where your business operates. And so as a CDFI, what we do is we offer resources, mentorship, and education to help businesses improve their financial health. We provide fair, transparent financing and financial education to small business owners, lending to every phase of a small business from startup to growth, and the loan products range from financing for working capital to fixed assets. So any questions on the SBA or CDFI lending, you can ask in the chat box and we can discuss it at the end of the slideshow, but those are just kind of broad basic overviews of what the SBI and CDFI lending kind of looks like. And I'm going to give you an example. This is the SBA microloan program through Pursuit. So this is one of our 15 plus loans that we offer here at Pursuit. The microloan program is very unique and awesome. It is $10,000 to $50,000 for loan amounts. The term is 6 years. The maximum interest rate is 9.125. It has a fee of 3% for the commitment fee, and that's actually financed into the loan. So nothing is actually coming out of your pocket. What's awesome about our microloan program is our decision is sent to you within 2 to 3 business days of submitting a completed loan application. It includes which includes all of the required documentation, which we'll also go over shortly. And the funds are dispersed to you within 5 days of approval. So what I love about this loan is not only is it fast funding, but it really can help out somebody who's even an established business, if you remember the capital continuum. So I always think of something along the lines of a pizza place. Say that their oven breaks. They may be 1,000% bankable and they can go to conventional lending and they can receive it, but they don't have the time to wait. They need the pizza oven and they need it fast so they can continue operating their business. This is a great loan that would benefit their business and quick and fast funding so that they can get back into operation. And now, as you saw in a previous slide, CDFIs need to offer kind of like a mentorship. Pursuit actually offers business advisory services. So if you are approved, say you're approved for that microloan we just discussed. If you are approved for a microloan, we actually offer post-loan technical assistance in the form of business advisory services. So this is our mentorship educational piece. So it supports the client, which can include financial management and budgeting, marketing and revenue generation, operations and growth strategy, HR hiring and retention, capital planning, and funding strategies. So that actually isn't an exhausted list of everything that we could offer, but this is just like the main highlights. These are the ones we tend to help the most. And so for the business advisory, for the business advisory services, it does set us apart. So if you're approved, you're actually working either with somebody in the Pursuit staff who is very well versed in this or an industry professional. I always say a lot of people know how to run their business that are coming from sole proprietors to hiring employees. They don't necessarily know HR, right? So they don't know they don't have an HR manual. So that is something that we can help them with at low or no cost to them. It is a wonderful resource. So to kind of transition a little bit, because this is everything you need to know, we want to get you kind of ready to approach a lender. I'm not sure where everybody is right now, and everybody has their own individual story, which we can always talk about on an individual basis. But when you're ready to approach a lender, these are just a few things that you want to take into consideration. What is the financial need and does it make sense? How much will it cost? And how much are you willing to contribute? So when you're trying to figure out the financial need, these are just a few purposes, loan products and terms, just so you can kind of have a general idea. Typical purposes that we see a lot of are inventory, receivable, or operating working capital. That is generally a loan product of a line of credit, generally, not always. Generally a line of credit, short-term need, where you're going to be using that and revolving and paying it off. I have seen working capital as a term loan as well, if it makes sense. Every business has its own need for working capital. Another purpose is equipment expansion, improvements, refinancing. That's typically a term loan. It can be 5 to 15 years, depending on the lender. And then owner-occupied commercial real estate. That's generally, you're buying a piece of commercial real estate. That's generally in the form of a mortgage. Not sure if everybody's heard of the 504 loan, but that is something the SBA offers and that Pursuit is a lender for. And those terms are much longer, kind of like buying residential property. It's 25 to 30 years. And we talked in a few slides before, when you're approaching a lender, you're going to want to know the APR. You want to be wary of lenders who don't provide you with this APR in order to do a loan cost comparison. There's a calculator there if you wanted to kind of calculate your APR. So there's a website there where you can figure that out. But the APR goes beyond the stated interest rate. It's interest rate, application fees, origination fees, closing fees, other fees, and repayment terms. And this would be your APR. And like we discussed with predatory lending, a lot of predatory lenders will not tell you this. And we've actually seen upward of 40% with some of these predatory lenders. So this is why we're offering you this information. And so you can actually have the tools to do your research with each lender and know if you're getting a fair interest rate, or a fair APR. Additional questions for our lender. You're going to want to know if you need to give a personal guarantee. 9 times out of 10, for any business loan, you're definitely going to have to provide a personal guarantee. You're personally guaranteeing that, yes, I'm going to pay this loan back. Some business loans, depending on the amount, will want you to pledge collateral. That means that, say you are unable to make the payment. Obviously, that's not what we're looking for, but you are willing to pledge that. I'm so confident I'm going to make this. I'm going to pledge my piece of equipment, my home even. You can take a UCC lien out on all my business assets. And if I don't pay that loan back, then the lender can take those assets back. We don't want to do that. We want you to pay your loan. Another question you want to ask is prepayment penalties. So a lot of small businesses will take a $50,000 loan, and then it is used for, let's say, marketing purposes, and we get them up and running with a website, and products can be purchased online, and they're killing it, and they can actually pay off this loan. For a loan with Pursuit, we have no prepayment penalties because we want you to be able to pay this off. A lot of some SBA loans will have prepayment penalties with different types of loans, but you want to make sure you understand which loans have prepayment penalties and which loans don't, and why that is. So that's something you want to ask your lender. You're also going to want to ask your lender what loan documentations you need. You're going to want to know how long you've needed to be in business, filing taxes, stuff like that. And we'll go into a little bit more detail on that as well. So as a lender, well, I've worn many hats in lending and have worked in conventional lending and CDFIs. Each lender kind of looks for something a little bit different, but this is the general overview. So we're going to want to know what the business is. What's the history of your business? There are some lenders who will not lend to certain types of businesses just because of their risk, and that is something that they can do, but they will always generally direct you into somebody who will be able to help you. So we want to know the history of your business. How long have you been in business? Have you been successful? What are your constraints, and what are the strengths and weaknesses of your businesses? Are you profitable? Can you forecast profits? They want to know the reasons for your borrowing. How much money do you need and why? A lot of people have a hard time kind of backing into that number, and we'll go over a little bit of who can help you with that if it's not your lender directly. And does the reason for borrowing make sense? I was trying to think of an example, and what I thought of was if somebody wanted to borrow $100,000 to make an outdoor patio, but their business is in Alaska and they can never have outdoor seating, that doesn't make sense. So that's something, you know, that the lender is going to look at. Does it make sense to ask for the money and why you need it? Personal credit. So because you're going to be giving a personal guarantee, we are going to look at personal credit. So if you know your personal credit score, depending on how you monitor it, just like kind of the realm of where it is. And does your credit report contain any red flags? This is something you should know. You should know if, you know, you've been late on a payment once or twice, something, if there's something in collections. You want to know if, you know, even if there's been fraud, if it's been reported on. These are things that you just kind of want to mention to your lender, because we're going to look at that. Generally, you're going to sign something off that we're going to pull your credit report and we're going to look at it and we're going to see it. So I always tell people to be upfront with their lenders, be like, hey, you know, I had a late payment XYZ, you know, 4 years ago. That's something we're going to take into consideration. It was recent. It wasn't a chronic problem. But if you know, and I'm not saying that we wouldn't, as depending on the lender, some lenders will overlook a few blemishes. Certain banks cannot, certain conventional lenders cannot, and certain financial institutions cannot. But there is a thing called exception-based lending. If the lender knows that you are, this loan is going to help you, so your cash flow is better personally, it might make sense to still put a loan out there for you. So don't get turned off by that. They're also going to look for liens and judgments if you have any liens or judgments, and they're also going to look if you have any back taxes to the IRS that you haven't paid on personal and on business. And if you're set up with a payment plan for those. So those are things that they're also going to look for. They're going to see if you filed bankruptcy in the past 10 years, if that's still on your credit report. A more recent bankruptcy is going to look a little different than a past that's maybe 5-6 years old. So don't get discouraged. We are still going to look at it, but always be honest with your lender, and we'll definitely be able to point you in the right direction. Another thing that lenders are going to look at is a debt coverage ratio. A lot of business owners do not know what this is, and that's okay. We are going to cover it, and it is a little bit tricky. And if you want to reach out to me after the webinar, feel free. I can go into more depth one-on-one with you. But we've kind of explained it here in the next couple of slides. And what we can do is, it's very basic, but a lot of people get confused with it. So we're here to help you kind of understand that. But it's basically showing us, after paying all of your expenses, is there any cash flow left? And can you repay all the existing and new loans? So this is something that all lenders will generally look at. You can hear it, you'll hear it called a debt service coverage ratio or a debt coverage ratio. So this is some paperwork that the majority of lenders are going to want and look for. Key assumptions and budget. That's generally, you know, your business plan or executive summary and kind of what your budget looks like. This can also be, you know, what it kind of blends into your profit and loss statement is when you're an existing business, we'll go to tax returns, interims, which your interims is depending on where you are in your business. So we'll want your filed tax returns, but say for 2023 this year, we're already into October. So as a lender, we're going to want to see your interims. We're going to want to see your profit and loss statement and your balance sheet for 2023, because it's not going to be filed with the IRS yet, depending on when your fiscal year is. So we're going to want to see those as well. We'll want to see a cash flow statement, and I also already said balance sheet. So what we're really looking at is your cash flow and how you're claiming income and how your expenses are filed, and if there's any income left at the end of the year. And that is where we can kind of transition into your capital needs. So when you were asking the lender's going to ask you like, okay, you need a loan. How much do you need? And that is your That is the number that we're trying to back into. So say you're a startup business. This is actually an example of a startup business. So the startup costs are $20,000. The working capital is $25,000. The equipment is $30,000. And then they're improving the space that they're leasing at $20,000. So the total is $1,000. So when I say, some people tend to want to back into that number, they're not 100% sure what they need. So we'll just do simple sources and uses. And this is kind of a general number. So, okay, it looks like we need about $100,000. Well, where is that $100,000 coming from? We talked in the beginning about, the owner. We want the owner to kind of have some skin in the game. And especially for a startup, you'll see that they will definitely want some owner contribution. And in this one, it looks like they're getting $20,000. So the owners are providing $20,000. They're going to receive a working capital loan for $25,000 and a long-term loan for $55,000, and that is $100,000. So those two balance. So your sources and uses are always going to want to balance. You obviously don't want to have $200,000 in uses and only $100,000 in sources. Then you're missing and lacking that $100,000, and nobody will actually fund to you because you don't have enough to open your doors. And that is a source and use for a startup. We can also do this for an established business as well. We also talked about credit report. This is a credit report that we just kind of pulled. This is a good one. So these are the three credit bureaus: TransUnion, Experian, and Equifax. This is a very good credit report. Basically, I'm sure that most of you kind of know, this doesn't have the accounts listed out, but this is what a credit report looks like. And the red flags, like we talked about, were the tax liens. We definitely don't want to see any tax liens. We're seeing a lot of defaults now on student loans to federal loans and stuff like that. Those are things you're going to want to watch out for. We don't want to see any open judgments or payment delinquencies. So banks are going to have higher credit scores. Generally, they're going to require them. Where the SBA and the CDFI, like Pursuit, can usually go a little bit lower. And we do focus on the red flags and we talk to them. But one of the big reasons alternative lenders have had to decline loans lately is because people owe taxes. And if you're set up with a payment plan, that is very different than taxes that you are just not paying. But like I said, we are seeing an uptick in active defaults on student loans and federal debt, and that actually is going to hinder any small business loan application. Now, I talked about the debt service coverage, and this is how it is calculated. We try to keep it simple here, and it really is not as complex as it may sound when I describe it. So this is a calculation that underwriters use to try and figure out your total cash flow and your total debt service. Obviously, all lenders expect to be paid back, and they want to be paid back. And it is it's not ideal for us to take your assets to play the loans. We don't want to do that. So they do this calculation to make sure that you can actually pay the loan back. So for total cash flow, a lot of people think it's their revenues. It's actually not. It's profits before taxes. So that means your profits minus your expenses. Okay, so that's profits minus your expenses. And then we have a couple add backs we can do, which is depreciation, amortization, and interest. And you'll see in there the line on your tax returns. If you want to just look at one of your tax returns when you get this slide, this is going to be your profit before taxes, which is line 21. So just remember, it's not your total revenue, it's your profit after your expenses, which includes salaries. And then you add back your depreciation, amortization, and your interest, and that's your total cash flow. Now, when you're calculating debt service, you're going to add your total monthly payment on existing debt. A lot of lenders will have you fill out a debt schedule, and that just shows any debt that the business pays on a monthly basis. So say you have a loan that's $1,000 a month, you're going to multiply that by 12, and that's your total monthly payment on existing debt. And then what we're going to calculate as lenders is the total monthly payment on new debt. So you are taking out a new loan with us and say that's another $1,000 a month. We're going to multiply that by 12. And then we're going to add those two together, and that's going to be your total debt service. So how you figure out the ratio is, this is how this is calculated. Banks generally, they generally require, bank conventional lending generally requires 1.25 or higher. Some of them are actually much higher than that. So that's something you're going to want to ask them. Another question you're going to want to ask your lenders. So you take that total cash flow from the previous slide and your total debt, and then this is actually a real example, 20,844 divided by 18. So your debt service coverage ratio is 1.16. So we want to see as a CDFI anything 1 or higher. So this is something where we kind of, as a CDFI pursuit, can go a little bit lower than a conventional bank can. So I want to keep this as simple as possible because everybody's DCR is going to be different, and it's something I can help you calculate and that we can work on together. So if you have any questions on that, just shoot me an email at the end of the webinar. Okay, so when you are applying for a loan, depending on the phase of business you are in, startups, I generally recommend, and actually I highly recommend, that you use outside sources for your business plan. There are small business development corporations, SBDCs. There's SBDCs throughout the United States. We work very closely with them, and they will help you with your business plan. So for a startup, you're going to want a full business plan. For an for an existing business, you're going to want kind of just an executive summary, just telling us what's kind of going on. Each lender may have their own need for a business plan, so that's something else you can actually ask them when you're applying is what would they actually need. Some established businesses, or say you're using the bank that you've worked in or used for 20 years, they might not require that. They're also going to want detailed info on borrowing needs. Generally, that's an application. So depending on the lender you're going through, that's generally their application. What are you borrowing for? Who are you? What's your business? What are your needs? And this is where it can get a little bit interesting. So 3 years of personal and business tax returns, because remember, your personal credit is going to come into play when you're looking to borrow funds for a small business. Startups, this is where it gets tricky, is startups. They're going to need 2 years of projections, and this is where that SBDC is going to help you. And if anybody needs a contact for the SBDC, you just reach out to me, and we will get you set up with someone at the SBDC to help you if you're a startup. So you have to have 2 years of projections. If you're a startup, that's just projecting your income, your revenue, your expenses. And then we would want 1 year broken out month by month. I talked about interim business financials. So we're already in October, so we would want interim business financials. So we have that 3 years of personal or business tax returns. And then we're going to want if you're an existing business, what's going on in 2023. The debt schedule I talked about, that's just your debts for the businesses. And then generally over $100,000, they're going to want you to fill out a personal financial statement. Some banks and some conventional lenders will want it a little bit less than that. So they're going to want, if they're going to be taking collateral, they're going to want to see where you are personally as well. So your business may be at one spot and your personal financials may be at another. So they're definitely going to want to see both of those. So we actually have at Pursuit, we have high level eligibility. This is very specific to Pursuit. So I'm kind of taking a step back now. So Pursuit offers, like I said, a bunch of different loan programs. And this is what we require for high level eligibility, which means that this is an automatic approval. We don't only do automatic approvals, and I'll go into that a little bit more, but this is for an automatic approval. This is what we would want to see. So we would want to see 2 or more years in business, a break even or positive cash flow, a personal credit score of 640 or higher, more than 120,000 in annual revenue, no tax liens or judgments filed within the last 3 years for you or your business, and no prior bankruptcies for your business. So this is an automatic approval. So if you can check all these boxes, this is an automatic approval. You would receive an email, and we could have you funded in 5 business days after the site visit. And so this is something that we pride ourselves on. It's very fast funding, and it is to hopefully keep everybody away from that predatory lending. We have seen a lot of businesses going after that because it is appealing when you need fast funding to do that. But people are trying to dig out from those higher APRs, and this is why we're having these webinars, so that you do know that we exist and we're here to help you. And so we do have a bunch of additional programs. I'm kind of getting to the end of the webinar. It is 10:38, so we got about 20 minutes left. I do want to mention just a few that we offer. Like I said, we offer 15+ loan programs, but we have some main core loan products that I like to mention. So as I've mentioned, we have the CDFI side. We offer microloans. They go up to $100,000. If you're a veteran, they can go up to $250,000. I'll go into more depth about that in a little bit. So those are the ones where I just showed you the slide. That's the faster funding, the micro lending. That's actually what I specialize in at Pursuit. We also offer the 504 loan, which I mentioned for commercial property. That can be commercial property or a large fixed asset. Think like printing press or just a commercial space. And then we also offer the 7A, which is basically everything else. 7A is where your startups are gonna fall as well. So we talked about the micro loan at the beginning of the webinar, and now we also have what's called a smart loan. Now there's going to be a bunch of different loans here that look very similar. I promise you it's my job to figure out where you fit best. I promise we're also trying to get you in the best program that's going to be the best for your business. So don't get too hung up on the names. That is my job to figure out, and I can discuss with you where you would fit best. So the smart loan is a little bit different than the micro loan. The micro loan was only up to $50,000, but the Pursuit Smart Loan provides access up to $100,000. And we send a digital application for all of our loans on the micro lending side. We have an approval in 2 to 3 business days. Loans are fully funded in 5 to 7 days. And the Smart Loan provides a responsible option for businesses that might otherwise turn to high-cost online lenders, like I discussed with that predatory lending. So this is a very good option for somebody, like I said, that pizza place, that oven broke, that need fast funding. But that's not the only need. Some people just prefer to work with us because we offer the post-loan technical assistance. We offer, that business advisory services with us. And then, oh, I'm sorry, skipped over that. So this is just the details on the Smart Loan program, up to $100,000. The term is up to 6 years. The interest rate is capped at 11.9. I'm not saying you're going to get 11.9, but that's what it's capped at. And again, the time of funding is a very quick turnaround of 2 to 3 business days. And then funds would be dispersed 5 business days after that. Another great product we offer, which is appealing to a lot of businesses, is our small business line of credit, also micro lending, so it's up to $100,000. The terms are 12 months. And after 12 months, we'll reevaluate. So sometimes what happens is a short-term need, a business applies for a line of credit, which we thought was a short-term need, but it turned into a long-term need. So then after 12 months, we're like, okay, it'd probably be better for you if we termed this out instead of kept the line of credit. So that's an option after 12 months. Also, if it is a short-term need and you continue to have that need, we will reinstate your line of credit for another 12 months, so we can revisit it every 12 months. So the interest rate on the line of credit is 9.9. The fees are 1.5, which are financed right into the line of credit. So you have unlimited draws on demand, and it's also monthly interest payments only. So that's super appealing to a lot of applicants, that you're only paying interest only. But again, you have to remember that this will be termed out after 12 months if it's not used as a line of credit. So we want to see you using it as, using the $20,000, paying the $20,000, and you use 15, paying that off. We don't want to completely maxed out to $100,000 and you only paying interest-only payments for 12 months, and then that's a term loan, which is okay, and that's why sometimes it happens that way, but we would just term it out after that. So this is the veteran loan I was talking about. We actually do a lot of these, which is great. So veteran loans are $10,000 to $250,000. The term is 6 years. It's at 6.75 fixed, which is a great interest rate. So loans under $100,000 are decisioned within 2 business days of submitting the complete application. When you get above $100,000, it can get a little tricky. It may require a little bit more time, and it also requires to be presented at our senior staff meeting, and senior staff will take a look at it. Sometimes when we get over $100,000, we will look to take collateral as well. If I hadn't mentioned it prior, $100,000 and below, we generally do not take collateral unless we're doing some exception-based lending. So for fees, this one is 2.5, and that's the total closing fee, and it'll be financed right into your loan like the others. We also have a minority and women revolving loan fund program. It's up to $50,000, 5 years, fixed at 7.75. And decisions are sent within 2 business days. You're starting to see a theme here. So while we have a ton of different programs, they tend to take, they have the same turnaround time. We try to work same. So that's why I say it can be a little confusing because we have a bunch of different lower amount loans, micro lending, that can get a little confusing. So let me figure that out for you. That is my job. So I think I have spoken enough for a Tuesday morning. My contact information is up on the screen. Please feel free to email me anytime. That is my number. You can call me anytime. And that is our website where if you want to explore a little bit more options. I am going to leave that there, hopefully to hear from all of you soon. If you have any questions, that is what I am here for. I am going to ask Theo if we have any questions in the question box.
We do not. So we are all set.
Well, I want to thank everybody for your time and interest in looking at this. I do think it's a very important topic, and I think it's important that as a small business owner, including myself when I was a small business owner, that you want to have a good foundation. If you're looking for lending, please use us as a resource. Use your Rensco chamber. They're absolutely wonderful there. You want to use the resources. We're here for you. We're in your corner, and I thank you for your time today.